we will have two gentlemen with a wealth of experience in the markets. First off, we have Geoff Howie. He's the SGX's market strategist, and he has been working in the field for 2.5 decades. He's hosting our very, very honorable and wonderful guest, the CEO and founder of Charlie Chan Capital Partners, who has 37 years of experience in the financial sector. Please welcome on stage Mr. Geoff Howie, and of course the legendary Mr. Charlie Chan.
Thank you so much, Edward. And good morning, ladies and gentlemen. And thank you very much for coming along this morning. And for all our online viewers, we wish you the very best and hope that you very much enjoy what we have in store for you over the next day, as well as Michael said, with the 20 quite comprehensive and extensive range of webinars that we have in the pipeline. So for the next 45 minutes or so, we're very lucky to have Charlie Chan, the Managing Director of Charlie Chan Capital Partners, with us, who, as Edward says, has 37 years of strong financial operational experience. I think you've been running Charlie Chan Capital Partners since 2011, and you've also a previous Managing Director of Credit Suisse. So what I think would be on the minds of most investors and traders is, as Edward mentioned, we are coming at the end of the first quarter of 2023, very quickly moving into the second quarter of this year. And as Michael mentioned, there are a lot of potential downside risks out there. And ultimately, going into this year, of course, risks were more tilted to the downside than the upside. And the most prevalent of those downside risks are obviously higher interest rates, decelerating growth, persistent services inflation, as well as you have these more extensive risks on the radar there of geopolitics and, of course, financial stability. And for the last 2 weeks, the financial stability aspect of the market has been in focus. And I wanted to ask Charlie what his take on this is, first and foremost, and is this the key downside risk to focus on going into the second quarter?
Yeah, hi, thanks. Yes, I think we have moved from the past 12, 15 years from a zero interest rate environment, or maybe 1% at most. So all of us have been used to paying next to nothing to borrow money. As Mr. Sin has said, it's no longer a buy and hold market, it's more a trading market, and you have to be careful as to what you buy. Clearly, when you make a mistake when interest rates are 1% and the company is still profitable, you can just hold on and you probably will get your way out of it. Second thing, like I'm sure you read a lot about these AT1 bonds. I think if something is paying a very high coupon or interest rate, well, be careful. Find out exactly what the fine print says. And if it's too complicated, you need a lawyer to explain to you, then obviously don't buy it. I mean, none of us will understand it. I remember buying some AT1 bonds 12 years ago, and I had to read and try and understand and get a lowdown as to what exactly will happen if I don't get my money back. So I'm glad to say I actually didn't hold any AT1 bonds after the first round of buying them. And I said, okay, enough. It is too complicated. So I think the main risk you're going to factor in is the much higher interest rates.
I think you touched on a point there in terms of understanding the products. And as Michael also mentioned in the opener, we have a plethora of, I guess, portfolio type of products listed on SGX that do suit very different type of scenarios and, of course, can be tailored to individual risk personalities. And as you just said, it's a trader's market for sure. And we see that in our REIT market, 20 cents in the dollar that goes to work into the Singapore stock market every day is in the REIT market. So while yields have been converging in the REIT sector with treasuries, you've got a very wide range of types of REITs that have also been attracting quite a little bit more, I guess, idiosyncratic volatility to their sectors and also providing trading opportunities, because there haven't been just downside risks. There's also been upside risks at work in the market every day, every week. So, Charlie, could we maybe explore some of those potential upside risks for the second quarter?
Yeah, I think REITs are okay to buy so long as all of us ultimately acknowledge that rentals will have to go up. You know, if you look at a typical office REIT, this building may have rented out for, call it $10 or so a square foot. Now, mathematically, if you work out that interest rates have gone up by 3%, then it is not surprising that the $10 rent will become closer to $13 so that the landlord will be made whole on his investment and he has enough money to pay DBS Bank, who's financing the building, for example. So I think you have to bear in mind that everything, there's no more free lunch. When rates were 2%, 1%, that's fine. Everything, you know, the building, if it's not fully tenanted, it doesn't cost the REIT much money to hold on to the buildings. You don't notice it. But when rates are 4%, yeah, I think you have to be careful and be wise as a serpent to choose what you choose to invest in the REITs. I think on the whole, in places like Singapore, with the government controlling the supply of stock of commercial buildings, residential buildings, you won't have a oversupply glut. Unlike in the US, I remember many years ago, you know, my guys in America were saying, why are you guys so keen in Asia Pac on real estate? Because in those countries, rents can go up and they can really crash by 50% when you have empty buildings in the city. I mean, that's something we don't see here because, you know, we have a very limited supply pool. So, and the government is in no hurry to let go new pieces of land for the developers to develop and flood the market. So I think here you probably have a good market to invest in because of fairly limited supply and the growth story that due to COVID, a lot of foreigners have chosen Singapore as a base to plant their businesses, and that will also be helpful.
And our REIT sector turns 21 years old since its inception in a few months' time. And I think a few investors have noted in the past that during inflationary cycles, REITs do, I guess, potentially have it, well, they have a history of mitigating against some of those inflationary forces, as you said, with the higher rental payments. So going into your 37 years, which obviously surpasses the REIT sector, what do you think hasn't changed in terms of the way markets are moving, trading methods to basically capture some of those market moves? You know, in broad terms as I could, what with the rate cycles and so forth, what hasn't changed the most and what has changed the most, you think?
I think size does matter. It's in almost any businesses. With a rather complex operating environment, it's inevitable that a bigger player will have more resources to understand the markets better, work out more scenario analysis, talk to more banks to get the cheaper level of financing. And that is very, very helpful. If you are too small, I think you do suffer the risk that you just don't have the resources to look into everything. I mean, if I can drag off on the side, America is facing a major banking crisis. But how many banks are there in America? The answer is 4,700. And how many banks are the size of JP Morgan, Bank of America, and the city banks? 10 or 12. The size of Silicon Valley Bank, which failed, was number 16 or 17 in the US. So now you have all these small banks. I think the Federal Reserve is very cautious because small banks are essential to running a small little town somewhere, where there could be one such small bank to support the whole town of 10,000 people. Now, if they were to impose the same level of control, then the small banks will never make money. Because first, they can't afford it. They don't have the expertise. You've got to hire all these very powerful mathematicians to model your business. So I still think size does matter. And I feel that it's safer to stick with the bigger boys in this town.
Which goes to, I guess, one of the key products we have here as well. As Michael mentioned, we have our Straits Times Index, which has 2 ETFs. The first has been trading since, 2002? Yeah, it is right, Wei-Chin. Sorry, thanks. And then since February 2009, we've had the Nikko Asset Management STI ETF as well. So from the inception, it's averaged 6% annualized total returns. We, as Michael also mentioned, we had the definitely the strongest performing benchmark across Asia Pacific last year, but it hasn't always been the case. You do have years of drawdowns. We're obviously very trade-centered economy. Much of it, almost half of our revenue that we measure with the big companies is generated offshore, outside of Singapore waters. What happens, or what do you think traders should take into account when you are investing in those big stocks or those indices and products that are based on the big stocks? What should you be taking into account when you have these big drawdowns? How do you think investors should be looking at managing the volatility that comes with, as you said, these crises that come along every now and then? Is there any particular method or motivations that investors must look at when they come to managing these drawdowns?
Well, I think most investors should be very careful on too much leverage in this time. And when rates are when you borrow money at 5%, you're going to think very hard, because you hold on for a year, it's cost you 5%. So watch out for the leverage, because that's a major killer. Second thing is, most of the news is out there. If you look at Singapore, I think the recent export numbers have all been negative for a good 9 months or 8 months. Every time it's trickling down, and who knows where the bottom is, but it's probably we are nearer the bottom than not. So you have to read the papers, the Business Times, and at least try and understand what is going on to make sure, because you have the economy, what's happening is quite important as a manufacturing center in Singapore and a financial center. You've got to know exactly what's happening.
And you said sometimes it's a little tough to gather all the information that's out there. There can be so much information, so much work to do. Are there any other type of cross assets that investors might want to look at on a week-to-week or day-to-day basis, such as commodities or fixed income rates, currencies, and so forth? Particularly, as you mentioned, the trade has been contracting in Singapore. The exports have been contracting since October, as they have in Taiwan, South Korea. Give us some examples maybe of some of the big, broader indicators that you like to check every morning.
Yeah, I think tourism is one sector which, we are on the cusp of having a recovery. It seems slow. I mean, honestly, I just came back from Hong Kong last week, and that place is slow. But I spoke to some of my friends there, and one of the guys who's big into the tourism sector, and he said to me, "Don't you worry, Hong Kong will recover, and fast." So I said, "Your airport looks shut. There are rows and rows of planes still parked in the ground, not ready to operate." He said, "But I've got China next door." And he said that lots of Chinese are getting ready to come in. Administratively, there's a lot of headaches. We went through the passport crisis, whereby most of us had the passports expired. We had a big queue at ICA. China is having the same problem. Over a 3-year lockdown with passports having a 5-year expiration, at least half the passports are out of date. So everyone's got to do it. But he said they will surely come. and they're not necessarily coming by plane. They just take the train to the border and walk and come in by ferry, by road from Zhuhai back to Hong Kong. So he thinks that you will see a sharp rebound probably by middle of the year. So that's something to think about. Are we going to take part in such a sharp rebound? We're only having 900,000 tourists coming in compared to 1.7 million per month. So we have some work to do. And if the way he describes it, that the Chinese are coming in by train and bus into Hong Kong, we're not going to see that, obviously. So it has to be by flying. And it takes a while for everybody to get used to flying again. That's my view.
But at the same time, markets have been so sped up ever since that reopening momentum kicked off November last year and the foreign ministry appointments were made. Markets became very optimistic. Many of our 100 stocks that report half their revenue to China pretty much saw a broad rally. But what we've seen is economies take more time, as you said.
Takes more time.
Yeah.
I mean, it's a matter of getting used to it. Now everybody's scared. I mean, I noticed that the train ride from into Hong Kong, the stations look a lot more grubby and dirty than it used to be. The chrome on the train was not as shiny as it used to be. But I think we have to bear in mind that this thing is going to take a bit of time to get to the same levels. So a lot of this is fairly long drawn. The other thing which is probably keeping us alive is the average visitor coming here is staying longer. I mean, it used to be 2.8 days per businessman or tourist. Now, all the trouble to come here, they're staying over 5 days. So you have some counterbalancing sides of the story. So I would say, just watch the numbers and look around. Do you see the tourists? I think it's a lot less than what it used to be.
But nonetheless, consumer cyclicals have been among the strongest sectors across the globe this year. Where there has been some sector switching as well is into the tech sector.
Yeah.
And technology, it just seems so fluid, the outlook in terms of when we had TikTok's CEO in front of a bipartisan, it was a bipartisan, what you call it?
Committee.
Well, he had to defend, obviously, the property, of TikTok and so forth, and the links to the Chinese government. Do you think it's the geopolitical fragmentation of technology that's really the strongest provider of the market cues for that sector at the moment?
I think the world has changed. Globalization is getting our favor. You see the geopolitical superpowers all hunkering down themselves. China and the US is in for a big fight. The US doesn't want to buy that much stuff from China for various reasons. They claim theft. TikTok as an example, the US claim is a good intelligence gathering tool, which I can understand why. I mean, right now, if everybody posts on TikTok every day their lives, the 150 million Americans, and a bad actor gets hold of this information, he can start cataloging it. He can take photographs of each one's house and catalog it nicely. And if somebody wants to use it to rob your house, you have given a lot of data to the guy on how to get in. So I think we have to be careful on how this data is kept and stored, and there are no real bad actors around to take advantage of this thing, which is why I think the Congress in the US has voiced some concerns. I mean, like now, I think government iPhones cannot have TikTok on it. So you just imagine everybody innocuously does a TikTok in the army camp. Very soon, everybody will have a picture of every corner in the army camp. So if somebody wants to raid the camp or rob the bank or what, he's got far more data. He doesn't have to go and take a photograph of where he's planning to go. He can just do this in addition to Google Earth. So I think there are reasons, and a lot of technology stuff may not be allowed to proliferate as fast as it has been before.
But it has such a wide field of application, these technology interfaces and platforms, and they're very prevalent, obviously, with the younger generations. But if I could focus now on the younger generation, what advice would you give them if they were looking to kick off their investing or potential trading careers now? What do you think they should be looking to, obviously, besides education or method and planning and so forth, if they still want to be doing this in 5-10 years' time?
I think tech stocks, the explosive growth is over. I think you could remember we had since 2008 a lot of quantitative easing, i.e. printing of money by the central banks. That went on. There were small skirmishes along the way. The central bank couldn't withdraw the liquidity. All this money went to the private equity firms, and quite a lot of it went to the tech sector. Going forward, with interest rates at 4-5% in the US, there isn't going to be much free money lying around. So without that free money, the private equity firms will have to find real good, solid investments to do. And I think the tech sector may not necessarily be the first to get the money as easily as they had in the past, which is why you hear stories like Google's firing 10,000 here, Facebook has done the same, and the smaller firms may, the TikToks of the world may have fired a few thousand here and there. So I would be cautious because of the world is going through a slowdown. That's pretty obvious. It's probably will be here in the next 3 to 6 months, when interest rates will probably have seen a peak. And then you'll see a downside, because the inflation worry is something which can only be killed by higher interest rates and for a slightly longer time. So there's nothing much the world can do about that. So it's in Singapore. If the rates in America are 6% for a while, at best we'll be at 4%. We won't go back to, it's wishful thinking if you say you go back to the 2%. I mean, you have seen that with inflation, the cost of food and all has gone up by 20-30%. It's not going to reverse. I don't think interest rates will reverse so quickly.
So in many ways, it doesn't matter what our wages are, we're all facing these new paradigms for markets now.
Yes.
So some of us, I've been in it for 25 years. You've been in it for 37 years. We're facing conditions slightly like we've never seen before, all of us. But how important is it for all of us to find our own style of approaching trading?
Yeah, I think that's most important. You find your own style. I think the day-to-day trading is probably for the younger guy who's got more energy and more time to analyze and look at things. For the longer term traders, I think study the markets well, talk to your broker, read the research which the broking house comes out, and there's a lot of information on the internet now, and then take your bets. But be prepared to sit down for a slightly longer time to see your return.
What do you enjoy most about trading, Charlie?
I think it's about getting it right, which is not that easy in a rising interest rate environment, I would say. And don't get caught out in the surprises which happen.
Okay, we might take some questions from the audience, and we have quite a few questions and quite a few votes. First question, Charlie, are there any particular sectors or industries that are likely to perform well in the 2023 market, i.e. maybe some of those inflation type hedges you mentioned, and how can investors take advantage of those opportunities?
I think tourism in the later part of the year should start making money. Things like what happens in Changi Airport, in the aviation sector, those are rather high-tech high in capital, and they need plenty of resources, and they work best when your flight kitchen, for example, is running at 95% capacity. So I think as we fill up, you'll find that the profit starts kicking in. Like Singapore Airlines. In the past, when they had 60, 70% of the seats sold, it never really made money. It just sort of covered its costs, small enough to pay a small dividend, nothing to write home about. But now when they are filling up 80 to 90% of their seats and not having all their planes working, they seem to have made far more money because they could control the price high, unfortunately. But invariably, it's a scale game, and high utilization of plant and equipment are important. So I still believe it's like a hotel. If you can sell 99% of your rooms, your last few rooms will be sold at a very high price because the guy needs to stay somewhere, and that's when the higher profitability will come in. So I think tourism, don't ignore it. It will come back, but it will take a longer time. It might also mean that we have less of the backpackers initially because the high costs is going to be making it very difficult for the backpacker to come and stay in Singapore. But by and large, I see that tourism is one of our major ones. Manufacturing, I feel that if the China fight with US, the Europeans having their war problems with Ukraine, some manufacturing will come back to the rest of Asia, and that's where we can see some pickup.
The question on are REITs still worth investing with high borrowing costs? I think you kind of touched on that because we have hospitality staple trusts, which are of course hotels. We have 9 industrial REITs that are investing in warehouses and depots, logistics centres to support the manufacturing sector across APAC. The question on are REITs still worth investing in with that high borrowing cost and that smaller premium of the REIT yield, average REIT yield here being 7% versus 3 to 4% yields. How would you answer that question?
I think REITs are still okay to invest in for the more steady ones, but you have to choose the best in the class. Don't buy too many small ones because the small REITs, don't have the scale. If one building is not rented out, you have a big fall in your distribution. So I'd rather buy the bigger boys. As we said, there will be more manufacturing after hopefully we bottom up soon, and that will mean higher occupancy. And anyway, JTC regulates the amount of land they give out to the buildings. So I don't see that as being a major negative.
And that kind of answers Lawrence's question there too on should an investor just invest in ETF, which is broad-based market index. It is broad-based, but remember it's always based on the most traded and the biggest of the sector, and hence that is a way to have more focus on the larger to the mid caps, while the small caps might provide higher beta to suit your portfolio through the different cycles. That question there, I know you want to answer. Recent bank run and issues, any problem for Singapore banks?
No, I think not. But then if you hold the AT1s, you just have to make sure you read and understand the fine print. That's very important. As I said before, I don't see the Singapore banks having a problem because there are only a few real banks here. So if tomorrow you don't like your money being in one of the banks, what can you do? Okay, I think the handphone is a very powerful tool. It means that you can take money out very speedily. I heard this on Bloomberg News, and they said that's something which I don't think the bankers realized. Like I looked at my phone, I could take $200,000 out of my account per day on using the Pay Now account I have. That is something which I think most bankers haven't realized, that the speed of execution is fast. In the past, you want to have a bank run, not so easy. You've got to go to the bank, queue up for hours. then the central bank says not to worry, everybody says not to worry, you might just give up. But now with the quick information, press a few buttons, you sent out your savings from bank A to bank B to bank C. Or now you can even buy treasury bills. So I don't see that as being, that is going to affect Singapore. There are too few banks, they're well regulated, well capitalized. The central bank is there holding the hands of everybody, and I don't see that being a problem in Singapore at all. So I don't think you need to worry too much.
Yeah, our three listed banks reported 27 billion Sing dollars of combined net interest income last year. And that's in the face of the Fed Reserve lifting rates now 475 basis points over 12 months or so. And importantly, the trio that make up a big part of the STI also, all of them reported loan growth and had customer inflows during that year. So this question on inflation also has a number of votes. How do you think inflation will impact trading, and what measures can investors take to protect their portfolios? Is that potentially a question where gold becomes relevant again? Because for Singapore investors last year, the gold ETF generated a small marginal decline in Singapore dollar terms, but that was because the MAS had effectively, between October 21, October 22, made 3 slight appreciations of the band and basically rescinded the band 3 times. So we had a pretty strong currency to fall back on. Whereas if you were a Japanese investor and you bought the Singapore dollar gold ETF, you would have made 13% return.
Yeah, I think the Singapore, just a bit of monetary policy. The Singapore MAS uses the currency, appreciates the currency if they feel there's an inflation rate risk. Because we depend, we spend a lot of imports. So a strong Sing dollar is good for keeping the price of imports low. So invariably, things like gold and all that, once you put your money into gold and you have to convert it back, the returns will suffer. But I think gold is probably a good investment. I think the MAS reports said that the MAS recently bought quite a lot of gold, and their gold holdings have been very steady over the years, and now they've increased it. China has increased their gold holdings, so has, I think, Russia, and most of Europeans have it. So I think gold will play an increasing part. Inflation will drive the price of gold up. I mean, one interesting story I read somewhere is that over the last 2,000-3,000 years, the salary of a vineyard worker used to be 1 denarii, which is 1/6 of an ounce. It's in the Bible, the story goes. It's quite explicit. And today, 1/6 of an ounce is still roughly the cost of hiring a vineyard worker to pluck your grapes if you had to run a vineyard. So it's a very good inflation hedge over millenniums, over 3,000 years. So I think, gold will be a good investment in the future.
With the yield curve as well moving forward, obviously it's inverted because of the blunt force trauma of having consecutive rates on curbing that sticky, stubborn, persistent services inflation is there. But does that give you any impetus or idea on carry trades going forward?
I think the Fed will probably have to reach a terminal level soon, because clearly the economy is not able to take these higher interest rates, and the 10-year, 30-year bonds are all saying that rates will have to peak and come down. So I think hopefully it'll be sooner than later, in which point when rates do come down, then asset prices will go up. I think most of you have seen it with your bank interest rate payments for your house mortgage, that the cost has gone up. And until the cost of money goes down, then you will all get a reprieve, and I think that's when the markets will start rallying, or probably 6 months before that. In the US, it's probably started already, the rally. I mean, most people expect the Fed to stop one more time and that's it.
Gold has been up, I think something like 8% since the 9th of March, since that STI moved below 3,200. Is it the safest investment given you've got two of those 5 key downside risks, financial stability as well as inflation, on the radar? Is it among, as you said, it is important to be and does have a place in the portfolio, but does it also get that extra credence given the notch up in financial stability, that instability or the nudge of financial stability that the focus on the mid-tier banks has made recently?
I think it is inevitable that you can increase your goal a little bit for safety. But at the end of the day, I think the central banks had a big wake-up call, and they are also keeping an eye on things. When interest rates were 1%, the banks could afford to keep plenty of liquidity lying around. To respond to this thing about possible need to increase your liquidity buffers under potentially new rules coming apart, it's going to be very expensive. None of us would like it, because if the bank were to keep more cash lying around in liquid stuff, they're not going to earn more money. So your savings is going to be less. Interest rates will, as a saver, you will suffer. As a borrower, the banks will say, yeah, no doubt I have the money, but I dare not lend you the money because you may not be able to pay me back in a timely manner. Because what's the bank's business? Take short-term money from savers and then lend it out for 5 years, 10 years to a corporate, or 25 years to a mortgage. So there's a mismatch there. And if they need to keep more liquidity, all of us are paying for it, be it the borrower or the lender, the borrower or the depositor. So yes, I think it will be a problem. It will take a while to adjust, but I don't see the financial risk as too high, because I think all the central banks have woken up and they are trying to do something to prevent further deterioration of the banking sector. I think it's well capitalized.
Did you want to touch on the AT1 focus at the moment with that question on the bondholder being placed below the shareholder in terms of the first claim? Or have you got a minute you want to?
Yeah. Okay, the AT1s, as I understand it, is basically an insurance contract, and it's written like a bond. So what happens when you buy an AT1? You give $100 to the bank, and then the bank says, every year I'll give you 8%. So it's like the investor has granted the bank an insurance contract. Every year he'll collect $8 of money. And what's the catch? If the bank becomes non-viable or it has shortage of capital, what is in the $100 you deposited will be forfeited. That's the contract. Now, I think there was probably a lack of understanding by many investors as to when can you take it out. But the central bank can decide that the bank is point of non-viability. That's the word. That's the key word. So if the bank is in trouble, big enough trouble, the regulator can solely decide that the bank is in distress. You're the insurance company, you have to pay up. It's like many of us buy critical illness. You don't have to be dead to collect the policy. You could be seriously ill, the policy pays out. And the banks will then get hold of the money to booster their balance sheet. And that's what happens here. Subsequently, a few days later, or even a day later, banks could then be sold off to a new investor to hopefully add more stability to it. So as I said again, in such complicated things where the payout is significantly higher than what you think it should be, do read the fine print. I think that's key.
I think we are coming near the end, and looking at many of these questions, and I know they are going to be answered in the course of the next few sessions by our next speakers. And if there's a question that you really wanted to ask Charlie but didn't want to put in the pigeonhole, do email it to me, and I will take that offline. Sure. Yeah, more than happy to
give you my thoughts on it.
Absolutely. But maybe as we finish the session, if there's one or two stories in your portfolio management career that you think are really worth sharing with the investors here today, that might have been a highlight, might have been a low light, but just a story or two that we can leave our investors with.
Yeah, I think there are stories, but there are many stories which you have to, mainly is the negative ones are by what I consider as bad actors, whereby not necessarily the company is acting in the interests of the investors. I've seen that happen many times. You know, buy a building from a sponsor, and you know it doesn't make much sense. You know, and you ask the questions. The manager says, "Well, this is the deal I was shown, and it sounds quite good." And I just tell them, "Hey, look at what you have. How can this building is giving you so much money because of rental support?" I think that's something to watch out for. The word rental support is, to my mind, something you'd be very careful. It's not allowed in countries like America. It's severely not allowed. But in Singapore, it's allowed. So you've got to really check whether the valuation is supported by rental support. And if the rental support cannot once the rental support ends, then you have to make sure that on a standalone basis, the rent is enough to pay you. That to me is a story of one of the lowlights.
Yeah, and then CRS is there, Business Times is there.
Yeah. I mean, I think it's a tough fight. I mean, and a lot of this is very technical. And I think stronger regulation is the only way out of this thing. I mean, there are many stories, you know.
But highlights?
Well, I think highlights would be, I think there are no real highlights. I don't think we are in a market whereby in the last 20 years, that suddenly you bought something for 10 cents and it became worth 50 cents. You know, I don't think that happens every day. So I think, you know, I can't remember anything really making that much money. It's just slow and steady grind. If you can make your 10% every year, then I think you're damn bloody good. You know.
And discipline, sticking to a trading plan.
Sticking to a plan, having stop losses, and understanding it, or when it gets too hot, and you still have your shirt on, then time to leave. You know, the table sometimes.
Charlie, thank you so much. I think we'll end here, but if there's any, as I said, any burning question that you wanted us to ask, do email me and we'll get you the answer, okay? All right, Charlie, thank you.
Thank you very much, Geoff and Charlie.